Video opens with a dynamic shot of stock market charts, both rising and falling, with a subtle calendar overlay flipping through years. Stopping at 2026. Hey everyone, welcome back to the channel. Today we're tackling a topic that might sound alarming at first, but stick with me because it's actually packed with opportunity. The potential for a market crash in 2026, and how you could use it to build serious wealth. Now, let's get one thing straight. I'm not a psychic. I don't have a crystal ball. Predicting the exact timing of a market crash is impossible. But what we can do is look at historical cycles, economic indicators, and patterns that suggest a significant market correction could be on the horizon around that time. Think about it. Major market cycles often run for about a decade. After the Great Recession of 2008, we had an incredibly long bull run. Then came the short, sharp shock of 2020, followed by a surprisingly fast recovery and more growth, fueled by unprecedented stimulus. These cycles of expansion eventually need to cool off. We're seeing several potential triggers lining up. Global debt levels are at historic highs. Inflation, which we've all been feeling at the grocery store and the gas pump, remains a stubborn challenge for central banks. To fight it, they raise interest rates. Higher rates make borrowing more expensive, which can slow down corporate growth and put pressure on company profits. It's a delicate balancing act, and if they over-tighten, they could tip the economy into a recession. We also have ongoing geopolitical tensions and supply chain vulnerabilities that add layers of uncertainty. When you mix these ingredients together, you get a recipe for volatility. So, while 2026 is an educated estimate based on these cycles, the key takeaway is that a downturn isn't a matter of asterisk, if asterisk, but asterisk when asterisk. So, a crash is coming. Sounds terrifying, right? This is where a crucial mindset shift needs to happen. For the average, unprepared person, a market crash is a disaster. They see their retirement account value plummet, they panic, and they sell at the absolute worst time, locking in their losses. But for the prepared investor, a market crash is the single greatest opportunity to buy quality assets at a massive discount. It's the Black Friday sale of the financial world. Every great fortune, from Warren Buffett to many others, was built not when things were good, but by being brave and strategic when everyone else was fearful. Your mission, should you choose to accept it, is to become one of those prepared investors. And it all starts right now, not in 2026. The first and most important step is to build up your cash reserves. Cash is king in a downturn. It's your dry powder, your ammunition. When stock prices are falling and everyone is selling, you need cash on the sidelines to go shopping. So, start today. Review your budget. Where can you cut back? That daily $5 coffee? The subscriptions you don't use? Redirect that money into a high-yield savings account. Automate your savings so a portion of every paycheck goes directly into this opportunity fund. Aim to save a significant amount, whatever is realistic for you. This isn't your emergency fund for a leaky roof. This is your wealth-building fund, ready to deploy. Step 2 is to create your shopping list. You don't want to be scrambling to figure out what to buy when the market is in a free fall. Do your research now, when you can think clearly and rationally. Identify fundamentally strong companies that you believe in for the long term. What does that mean? Look for companies with a durable competitive advantage, what Warren Buffett calls a moat. Think of giants like Apple with its incredible brand loyalty, or Microsoft with its dominance in enterprise software. Look for companies with healthy balance sheets, low debt, and consistent profitability. These are the businesses that will not only survive a recession, but will likely come out even stronger, capturing market share from weaker competitors. Your list should consist of 10 to 20 of these high-conviction companies, across different sectors, to ensure diversification. Step 3 is about mastering your own psychology. This is honestly the hardest part. It's easy to say you'll be greedy when others are fearful, but it's incredibly difficult to do in practice. When you see the news headlines screaming about market chaos and your portfolio is down 30 or 40%, your every instinct will tell you to run for the hills. This is why preparation is so important. Educate yourself on market history. Look at the charts for 2008. Those mil 1987. Every single major crash in history has been followed by a recovery and a new all-time high. Every single one. Internalize this fact. Remind yourself that you are not buying for next week or next month. You are buying for the next 5, 10, or 20 years. You are buying a piece of a great business at a price you may never see again in your lifetime. So, when the time comes and the market starts to tumble, you'll be ready. You won't panic. You'll calmly pull out your pre-made shopping list and your cash reserves. This is where a strategy called dollar cost averaging, or DCA, on steroids comes in. Don't try to time the absolute bottom. That's a fool's errand. Instead, as the market drops, you start buying in increments. Let's say the market falls 20%. You might deploy 25% of your cash. If it falls to 30%, you deploy another 25%. If it drops to 40%, you get the picture. By averaging in, you ensure you're buying at progressively lower prices, significantly reducing your average cost per share. This is how you set the stage for explosive returns when the market inevitably recovers. Imagine buying shares of your favorite tech giant or a solid blue-chip company for 50% off. When the economy gets back on its feet and the market begins its climb back up, your portfolio won't just recover. It will surge. The positions you establish during the downturn will be the bedrock of your future wealth. This is how generational wealth is created. It's not through complicated day trading or chasing hype stocks. It's through simple, patient, and disciplined action during times of crisis. To recap, a market correction is a natural and healthy part of the economic cycle. While we can't predict the exact date, signs point to a potential downturn around 2026. Instead of fearing it, we should prepare for it. Start building a cash position now. Create a watch list of high-quality, fundamentally sound companies. And most importantly, steel your mind to act decisively when the opportunity presents itself. Don't let fear dictate your financial future. Let preparation and strategy be your guide. This is your chance to turn a period of market fear into a life-changing financial victory. Thank you so much for watching. If you got value from this video, please hit that like button. And be sure to subscribe and turn on notifications so you don't miss our future content. Let me know in the comments what companies are on your watch list. Until next time, stay prepared and invest wisely.